Markets are tanking, inflation is still high, and you're wondering, should you panic or profit? In 2025, recessions are real, but smart investors know how to protect their wealth and even grow it. Today, we're breaking down the safest, most effective strategies to invest during economic downturns and come out stronger on the other side. Forget the fear-mongering. It's time to get strategic. So, what exactly is a recession and what should we expect? Simply put, a recession happens when the economy shrinks. Job losses tend to rise, people spend less, and the stock market often takes a nosedive. It sounds scary, but let's look at the facts. Since 1950, the US has gone through over a dozen recessions, and on average, they last about 11 months each. During these periods, the S&P 500 has historically dropped around 30%. But here's the crucial part. Markets always, eventually, recover. Knowing this history helps us make calculated moves instead of emotional ones. It's not about avoiding the storm, it's about learning to sail through it. First up, let's talk about building your financial armor. Defensive stocks. These are companies that provide the absolute essentials, things like food, medicine, and electricity. People keep buying these products and services no matter what the economy is doing. Think about companies like Johnson & Johnson or Procter & Gamble. They have a long history of paying consistent dividends, even during tough economic times. Utilities and consumer staples sectors often outperform the broader market when the economy is contracting. For a recent example, look at the 2020 crash. Defensive sectors fell less dramatically and recovered much faster than the market as a whole. Adding these types of stocks to your portfolio can be a fantastic way to stabilize things when the waters get choppy. Next, a timeless rule that becomes even more critical during a recession: diversification is key. You've heard it before, but never put all your eggs in one basket. This means spreading your investments not just across different stocks, but across different sectors, asset classes, and even different parts of the world. A well-diversified portfolio might include a mix of those defensive stocks we just talked about, some broad market ETFs that track the entire S&P 500 or total market, and a portion in bonds or other fixed income assets for stability. Historical data is crystal clear on this. Diversified portfolios experience smaller drops during recessions and bounce back faster. Even a simple 70-30 split between stocks and bonds can significantly smooth out the volatility and help you sleep better at night. Now for a strategy that I personally love because it takes the emotion out of investing: dollar cost averaging, or DCA. This is your absolute best friend in turbulent markets. The concept is simple. You invest a fixed amount of money at regular intervals, say, every month. When the market is down and prices are low, your fixed amount buys more shares. When the market is up and prices are high, you buy fewer shares. Over time, this strategy automatically lowers your average cost per share. It completely removes the stress and guesswork of trying to time the market. During a recession, DCA is a powerful tool that allows you to systematically take advantage of lower prices without ever having to make a panic decision to buy or sell. During a downturn, it's tempting to chase after hot stocks that promise a quick recovery, but that's a risky game. Instead, focus on long-term quality. This means investing in financially strong, blue-chip companies. What does that look like? You want businesses with low debt, strong and consistent cash flow, and a history of paying and even increasing their dividends. Think about giants like Microsoft, Apple, or Pepsi. These companies have weathered multiple recessions and have not only survived but thrived, delivering substantial returns to long-term investors. In a recession, the golden rule is quality over hype. Stick with the proven winners that have the financial strength to endure the tough times and lead the way in the recovery. Alright, this next point is probably the most important piece of advice in this entire video. The single biggest mistake you can make during a recession is panic selling. When the market is crashing and everyone around you is freaking out, your gut instinct will be to sell everything to stop the losses. You have to fight that urge. Selling at the bottom locks in your losses and means you'll miss out on the recovery, and recoveries can happen fast. Studies have shown that missing just the top 10 best days in the market over a 20-year period can slash your portfolio's growth by over 30%. It's a staggering number. So, stay disciplined, hold onto your quality investments, and always remember this classic investing mantra: time in the market beats timing the market. While defense is crucial, recessions aren't just about survival, they're about opportunity. Some of the greatest fortunes in history were built during downturns. When fear is at its peak and prices are at their lowest, that's when the smartest investors start buying. The best returns often come right after a market crash. So, how can you play a little offense? Consider buying high-quality ETFs or individual stocks that are now on sale at a significant discount. This is also a great time to add to your dividend-paying positions to increase your future income stream. You can also rebalance your portfolio, selling some assets that have held up well and using the cash to buy more of the strong companies that are temporarily beaten down. Just remember, patience is everything. Recessions always end, and the markets always recover. So, let's put it all together into a simple, practical action plan for 2025. First, review your portfolio and make sure you have a solid allocation to defensive stocks and ETFs. Second, ensure you are properly diversified across different sectors and asset classes. Third, commit to dollar cost averaging by setting up automatic monthly contributions. Fourth, focus your new investments on high-quality, long-term companies. Fifth, and most importantly, make a promise to yourself to avoid emotional reactions and panic selling. And finally, plan to rebalance your portfolio periodically to take advantage of the opportunities that downturns present. Following this straightforward approach allows you to invest safely through the storm while positioning yourself perfectly for the inevitable market rebound. Recessions can be scary. There's no doubt about it, but for the informed and disciplined investor, they are a springboard, not a stumbling block. By using defensive stocks, diversification, dollar cost averaging, and maintaining a long-term perspective, you can build a portfolio that's resilient enough to weather any storm. These are the tools that will help you protect and grow your wealth in 2025 and beyond. So, which of these strategies will you implement first? Let me know in the comments below. And if you found this helpful, please hit that subscribe button and join our community. Let's build wealth the smart way, no matter what the economy throws at us. Thanks for watching.